Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, we're going to bring in Andy Swan. He's a co-founder of Likefolio. Welcome back to the show, Andy.
Thank you.
All right, so we're talking Disney. A lot of problems, a lot of headline issues for this company over the last year or so. Jenny highlighted some of the, some of the outliers here. You know, they're discounting at the parks. They typically don't do that heading into the holidays. Iger's not working his magic like a lot of people thought. Stock's down 3% on the year. Do you have the data to back this, this weakness up?
You know, we did have the data to back the weakness up, but we saw a significant shift. About a month ago, we actually started getting bullish on Disney. And the real reason why was a shift in that consumer behavior and sentiment. And it really started with the streaming side of things. For a while there, Disney Plus was really not very well liked compared to peers. But now we're starting to see it and their subsidiary ESPN streaming all start to really show some signs of really high levels of consumer satisfaction, especially when compared to peers. And I think that's a really, really good sign for the company because, like I said, this was an avenue of defeat for them if we just kind of go back a year or 9 months ago. And so I think that shift has been very significant to the positive side. The other shift that's been positive has been, the number of people talking about, going to their parks and recreation web pages. And so that tells us that people are looking to book Disney experiences and Disney vacations. Yes, that might be in response to some of the price cuts, but the fact is Disney isn't going anywhere in terms of its place in the American heart and mind. It's, gone through a rough patch, but people are still looking for that experience in the Disney parks. It's still the best experience, I think, that families can have in the country, if not in the world. And so, I think for the most part, Disney's troubles are mostly in the rearview mirror. And I think Bob Iger is starting to work his magic. It just took a little longer than expected because I think the problems were bigger than expected. And there's still some problems in the pipeline, but I think that the company's done a good job of listening to the customer and reacting. I think moving forward, we'll be in good shape.
Andy, you put up a great chart about the consumer happiness of Disney and how they dominate this space. I'd like to see the investor happiness of Disney. I'm thinking it'd be the opposite, but that's another story. Bob Iger promised that he'd get streaming profitable, and he has been ratcheting the levers on this, getting down expenses and raising prices slightly. They lost 5% of their streaming, but they're getting closer. Bob Iger will eventually get this ship righted in the right direction. It's just a matter of how much pain he has to go through to get there, right? The parks, that experience is still doing extremely well. And Andy, as CEO Andy Swan, what is he going to do with ESPN?
Well, I think he's going to turn ESPN ultimately into a sports betting platform, and I think there's a lot of potentially very lucrative concepts in that regard. And so I love the ESPN platform. I think the consumer happiness level going up for ESPN is getting better. I think they've started to get away from some of the politically charged coverage that they're doing. They're getting back to the basics, and that is sports betting. How do we make people engaged with these activities and how do we profit from that engagement? I think is the 1-2 that they need to worry about and leave everything else to the side. I think they've got most of that stuff in the rearview mirror. At least I hope so, as both a consumer and now a shareholder.
Andy, when you look at this company, they split themselves into three structures now: entertainment, the sports, which is basically ESPN, and then experiences, which are hotels, cruise lines, and the parks. The parks have done pretty well at this point. Wages, are an issue for them as far as inflationary pressures. They cut staff. They were one of the first companies to do it. When you look at this, the stock that's bounced off that, $78 to $80 level, do we have that good base in here, according to your data, where, hey, there's going to be upside in this company, but it might not be immediate?
Yeah, that's the way I think you have to think about Disney. You have to zoom out and say that, look, this is a great American company that has been through turbulent times before. We're in a turbulent time now because the consumer's a little bit weak and the company's gotten, itself into, it's caused its own missteps in many ways. The consumer weakness probably persists for a while. I think the economists, everybody that does that stuff agrees on that. But from a, getting in its own way, I think that part of Disney is in the rearview mirror. I think Bob Iger has the right plan. It's going to take a little while to get through it, but the stock is already acting like this company is a disaster for years to come, and I just don't believe that. I think we could see a turnaround in that investor sentiment that follows the consumer sentiment. That happens a lot with Folio data, and it looks, like something I'd be willing to bet on here.
Yeah, just a month ago, Andy, this stock hit lows that we haven't seen since 2014. So to your point, Kevin, investor probably not very happy with that. All right, great data as always, Andy. Appreciate it.
Thank you, guys.
All right, that's Andy Swan, co-founder at Folio.